Hello there, welcome. You're watching the Your Trade. That's a special day today. I'm Priyanka Uppal, along with me Sneha. What a rout on the Indian streets. In fact, not just on the Indian markets, but in fact, it's a global sell-off what we witnessed today. The losses which followed since the Friday, the losses we saw in US markets, Asian markets, European markets, that seems to be catching up on Indian street also. Nifty fell below 24,000, did recover, however, 200 odd points and closed somewhere around above 24,000. But we saw a good dip coming on Nifty, Bank Nifty, India VIX spiking more than nearly 45%. However, we saw some of the sectors recovering later half of the day, but the major hammering which we saw was on Nifty. Reality, IT registered the biggest intraday fall in over 1 year. Nifty Bank, it was more than 2.5% fell losses what the index shed today. PSU Bank got hammered by more than 2% today. The day clearly, and the kind of derivative data which is coming in, the immediate strike also, the action by the traders, what we see is the call writing on immediate strikes like 24,100, 24,200. Clearly a day to remember, a day which is, of course, it reminds you, Snehi, the day or the budget day, or maybe the COVID days, when there were reasons, there were bigger reasons. Now, the election days. I'm sorry, not the budget day, the election days, but there were bigger reasons. But here, there was an anticipation that we could see a jitteriness across the markets. We could track a steep sell-off in equities globally as investors are grappling with the worries of recession in the United States and the subdued jobs market that added to the woes, which was mirrored by Asian markets, European markets, and now. But then now we have to see the important things which has to be followed is that how is European market closing, and later how would US market open up. Right now, the signals doesn't seem to be anyway improving.
Absolutely. Well, to sum it up, it's been a mayhem on Dalal Street today. Not only our markets, like Priyanka mentioned, lots of markets globally tanking in, but especially you had the Nikkei that was really down today. It closed with a cut of almost 12.5%, more than 4,000 points cut coming in intraday on just that one index. And we'll tell you why. It's because of yen carry. We'll tell you about that a little later as well. But as of now, let's make sense of the trading session we've seen and what we can expect going into the trading session tomorrow. We are being joined by Manish Sonthalia, the Director and Chief Investment Officer at Emkay Investment Managers, and we also have Rajesh Palviya, the Head Technical and Derivative Research at Axis Securities, on board to help us with the technicals. Thank you, gentlemen, for joining us on such short notice. And Manish, I'm going to come to you first. Help us understand the kind of moves that we've seen today. And two questions for you. A, is this something to really panic about? And B, what should investor strategy be now? Is now a good time to buy? Should we wait a little bit more? What's your pick here?
I think the yen carry trade would have limited impact on India, at least fundamentally, because the FIs have been selling over the last 2.5 years, and we really have seen their total allocation to India's total market cap go down from 22-23% to 16-17%. So that's one. And secondly, I would believe that, you are likely to see more of a sector rotation. You were seeing some sort of a bull fatigue in some of the high-flying sectors like capital goods, railway, defense. All in all, I think, as long as oil is down and, this is due to slowdown in China or, let's say, Middle East tensions, that's actually a positive for India. As far as global rates are concerned, we haven't, to my mind, seen too much of a yen carry trade happen as far as India is concerned. And if we have withstood the election results and the budget jitters, I think again out here, you would see a case where if you buy the dip, of course the right dip, the right sectors in the dip, I think you should be better off than, just selling into this fall across the board.
Let's see how it pans further. But then we do have Rajesh Palviya also to talk on the technicals here. Rajesh, good afternoon. Let us know that what are the crucial levels that you're tracking in. Bank Nifty, the crucial support was at 50,000. It did breach that also, and Nifty also breached 24,000. We did recover, but then the immediate strikes where we see an action by the traders certainly creates a cautious sign.
Good afternoon, Priyanka. So both indices have witnessed a short built-up in derivative data today. The way the Nifty and Bank Nifty has broken their near-term support area, we believe that till Nifty is trading below 24,250 mark, there is furthermore supply pressure we can see in the Nifty. Though we have almost moved to the level of 23,900 during the day, and some mild recovery from those levels we have already seen, but still looking at the technical structure also, 23,850 is the 50-day moving average for the Nifty, and we believe that the way short built up is there in the derivative data, there is a high possibility that we may break 23,850 mark in coming session, and if it happens, then this supply pressure can extend, and then possible down move can be extend to 23,600 to 23,500 also. That's the major put based concentration on the derivative side. For Bank Nifty, almost major put writers are now at 50,000 as well as 49,500 strike. For Bank Nifty, we have already broken the 50-day moving average, and looking at the setup on Bank Nifty, we believe that if we slip below to 50,000 mark in coming session, then further follow-up selling action can be there in Bank Nifty also, and then next target for Bank Nifty we may see towards 49,500 in a short span of time. So both indices are looking weak at this juncture till Nifty not crosses 24,250. One should remain on the short side of trade for index, and for Bank Nifty, till Bank Nifty not manages to cross above 50,450. Again, here also there is a opportunity to remain on the short side of trade for Bank Nifty also.
Tell us, Manish, one key thing which I wanted to understand, since we understand that if there is a worry, the entire picture look very worrisome. If there is, that's a famous adage which is also said, if US catches flu, of course the the global markets will also feel the impact of it. But then to break down this data, did we overreacted? Did Indian markets overreacted to the kind of fall we saw? Because as per the NSTL data, if the yen carry trade is one of the big reason for this sell-off, then the Japanese FI, they hold nearly 2 lakh crore of Indian equities, whereas they hold a very big position in US markets. Is that really worrisome for Indian markets? It is worrisome for US markets if this entire yen carry trade has to be counted into.
So around $20–25 billion worth of equities by Japanese FIs is not too much of a worry given the total market cap of India. And I think India is a peculiar market when there is a buy, everybody wants to buy, and when there is a sell, everybody wants to sell. I think this momentum sort of mindset is the main root cause of all problems. But having said that, I think Indian markets are extremely light in terms of positions. They are well supported by fundamentals. Most of the sectors, apart from a few sectors where there is a lot of froth, and there is every reason for this sort of froth to be taken out. But having said that, if roughly 45% of the total market cap of Nifty 50 is represented by two sectors like IT and banks, I think both of these sectors are not very exorbitant in terms of valuations, and neither have they really participated too much in the recent rally. What has participated is the capital goods, defense, infra. They have every reason to correct fundamentally, and I'm talking just fundamental, because they have run up just too much and well ahead of fundamentals for the next 2 years, maybe the next 3–5 years. They can correct, and there's a lot of positions that have been built in all these spaces on the delivery side. But as we see things now that there is a rotation trade, having seen the budget, having seen the numbers, having seen the monsoons, and I think there is a case for money to move into banks, IT, pharma, FMCG, consumer discretionary. These are defensive in today's context as opposed to capital goods, infra, real estate, high beta sort of names. And even in today's fall, you have really seen some of these sectors have really performed well in spite of the markets correcting. So the texture and nature of Indian markets will undergo a change. In terms of absolute fall, I don't see too much of a fall from current.
So those are the sectors that are looking good and also the ones that are looking slightly overvalued. To Manish, Rajesh, I'm going to come to you and also want to get your quick sectoral view in. And also other than that, I've been hearing word on the street that there is some buzz that the Fed may actually go ahead and cut its interest rates even before the next September meeting is due. Do you think something like this could happen? And if not, if you think that they will wait till September to do so, how much of a basis point rate cut are you penciling in for the September meeting?
So I think this is all buzz is happening in the market, but I don't think this will happen on an immediate basis. There could be some meeting or some measures they can take or some announcement would be there, but still I think they'll wait till September meeting. And if at all they will go with their schedule, so I think till the time these kind of measures not happen, market may remain under pressure only. And I think there is still pressure we can see in the global economy related stocks like IT may have some pressure, some automobile stocks may face some more pressure. So I think still volatility is likely to be there, and I think as the setup is already weakened for the near term trend, so we believe that furthermore sell-off activity would be there in IT as well as in automobile space in near term basis. So I think one should remain on the cautious side till this global markets not stable at any given level, or even on the Indian market also the Nifty, Bank Nifty till not settle at any level. I think one should remain on the cautious side of trade.
So you're suggesting a cautiousness, do not hurry in buying it. Thanks very much Rajesh and Manish for joining in at such a short notice. Thank you so much for your insights on the subject. Very valid question also, Snehi, the way you asked, because this is the time where you actually have to explore that is it the right time to buy also. We'll stay in for a short break, more to come. We will get you the more reasons on what is yen carry trade that is reversing, which are the stocks which will get impacted directly, which did get impacted today also and possibly in future days to come also.
Hi there, welcome back. Let's keep it going about everything that the global market saw today. I specifically want to talk about Nikkei today because Japan's Nikkei did see some very sharp cuts coming in, almost 12.5% lower just intraday. And it's not only today, right? Because Japanese markets have been seeing this kind of cut coming in 4%, 5% over the last couple of trading sessions as well. But with landslide cuts being seen in the Japanese markets, the currency was also reacting in tandem. The yen also strengthened to 7-month lows. Let's go across to Sharat to understand the impact on Indian equities with respect to investments and financial exposure to the yen.
Well, yes, yen has strengthened to its 7-month high levels, and now let's look at what the impact would be there for the Indian stocks. And of course, firstly is Maruti Suzuki, which is very important to mention. Of course, it's expected to be negative 2 points. One is royalty payment, and secondly, they also source materials going ahead from Japan itself. So both of them expected to turn expensive or becoming a sentimentally negative news flow. They're around 3% of total income is paid as royalty to Suzuki Motor Corp, and almost 4 to 5% of annual income is directed towards yen imports for sourcing of these materials. Roughly 15 to 16% of company's raw material costs come from Japan, and which is billed in yen. And interestingly, company has smaller stakes in Jet and Asahi India Glass also, who are technically their shareholders as well. Also, royalty payments, if you look at it, the negative impact coming in for Lumax Industries, they pay almost 1.25% revenue to Stanley Electric, which is itself a Japanese MNC, and also Jet India, they pay 5% of revenue to Jet Corporation. Also, there are certain segmental revenues where exports happen to Japan, and we did a research from a screener at Bloomberg, and we got to know the certain stocks such as Azad Engineering having almost 37% revenue coming from Japan. Also, Uniparts, Nava, and Aether Energy, HEG, Jet having stakes between 1 to 5% when it comes to the revenue contribution. Now, interestingly, let's look at the Japanese investments in India, especially through the promoter route. And of course, we are having companies such as Jet India, almost 70% stake is there. Large stakes coming in for Honda India Power, Maruti Suzuki, as we have mentioned, SML, Isuzu. And also, if you look at the 30% odd earnings coming in, that includes Lumax Industries, Motherson Sumi Wiring, and even Asahi India Glass and Samvardhana Motherson International. So a lot of Japanese companies' investments are actually put up, and they are labeled as promoters in these investments in Indian companies.
Very much, Sharad, for all those factors, and then with multiple factors leading to a big fall in market. Our editor-in-chief Nikunj Dalmia also gave his take on what should be investors' next step looking like.
Last two local events, if you bought the fall, it's been a rewarding experience, which is that, let's say you bought the market on the day when markets fell on the election day, or you bought the markets on the day when elections fell on the budget day. When the news was not something what markets were expecting and you bought the fall, you were handsomely rewarded. But this market, when I say this market, Indian markets were due for a correction. Correction comes and knocks you. You don't know when and how. But what do? Do you go out and buy? Well, you don't go and buy this first correction, because this is a global correction. And typically when the global correction of this magnitude comes, it's not going to settle down in a day or so. And rather than being a compulsive buyer on decline, I would say it's better for the trend to settle down rather than just jumping on the first flash, because recency bias is something which we all suffer with, and the recency bias of what happened on the election day, 5th of July, what happened 5th of June, what happened to the market on 23rd of July on the budget day when you bought the market fall, I think is something which tends to have an impact on India. But you were due for a fall. Global markets were due for a fall. When it hurts, when it hits, it will hurt you. And today I think a lot of portfolio repositioning will happen. The VIX has gone up 50%, and typically when VIX goes up in such an elevated manner, those are not the times when you buy. You buy something when there is either outright value, or there is sign of a reversal, or there is reasonable amount of conviction. Now, where do I have reasonable amount of conviction? Here's where I have reasonable amount of conviction, Cheryl. My reasonable amount of conviction is coming from the fact that Indian corporates are not leveraged. So even if interest rates and carry trades reverse, it's not going to have an asset shock like 2008 when corporates were leveraged. That's the first thing you need to look at a global sell-off. Second, the macros in India are getting better. Interest rates are coming down. And, the positioning of the bond market is also such that I don't think there is a problem in terms of a macro reversal. Third, there is a lot of support which is coming from SIP investors. They're not going to go away in a hurry. Fourth, we are still in an economy which is growing. The risk is valuation, risk is not growth. This kind of an asset sell-off, I think this is more like unwinding rather than event-based. Typically, markets, they peak out when there is event or when there is a huge risk of valuations. So this extraordinary run-up, I think, in equity as an asset class is getting checked. We will get hit, but if others are getting hit, we will get scratched.
All right, well, that's all the time we had on this edition of Coping with the Sell-Off, something that we've been dealing with all day long today. But as we bid you goodbye, let's also take a look at what Jim Rogers had to say, because we interacted with him in the morning to understand the spillover effect of the US slipping into a potential recession on the back of that weak jobless claims and the jobs report that we did see coming in last week. He also spoke about the yen as a currency, global macros weighing in on India as well as other global markets as well. Let's go across and listen into everything he had to say.
The U.S. has not had a problem since 2008, 2009. That's the longest in American history. So America, and therefore the world, is long overdue for a problem. And I will say to you, I have a lot of cash. The reason I have a lot of cash is because I expect the next sell-off to be the worst in my lifetime, because the debt has gone up by so very, very much everywhere. Even India has debt now. So you should be worried. I am worried. I am waiting for this collapse to come because I know it's going to be very, very bad. Maybe it's here. I don't know. You know, the world markets have had problems every few years for centuries. It's not unusual. India has been very strong, but everybody has been very strong except China. So we're overdue. Usually there's no specific event which causes a market to top and start going down. I don't know a specific event except all markets have been going up for many years. The Indian market is at an all-time high. That's true of many markets around the world. So when everybody's having a good time, it's a time to start worrying. But often when markets start going down, everything goes down. Gold, silver, everything. Now, gold and silver often make the first bottom and start going up before the stocks do. So this is not unusual for me. I own gold, I own silver, as you know, but I'm not buying now. I'm waiting for a better chance.
Charu Channan joins us, global strategist, head of fixed